The Civil War has been over for nearly 30 years now. 6 railroad lines cross the country from the Atlantic to the Pacific. We are an energetic, growing nation that carries on trade from coast to coast. And our currency has been backed by gold and silver coins since 1879.
But the backing of currency was to become an issue.
We've been enjoying a rapidly growing economy, but now with this slow money growth, well, prices are falling, people are out of work, and business is in a slump. Farmers know that falling prices are hurting them too. There's just not enough money available. Business can't grow, people can't spend, and prices continue to go down. Something must be done. What's the problem here?
The problem was that money wasn't growing fast enough because there wasn't enough gold and silver on hand to back it.
Masses of this nation and world, supported by the commercial interests and toilers everywhere, we will answer their demand for a gold standard by saying to them, you shall not press down upon the brow of labor this crown of thorns. You shall not crucify mankind on a cross of gold.
In spite of such strong words and dramatic oratory, Bryan was defeated by McNabe. 4 years later, Congress put the United States on the gold standard. This made official what had been fact for some time. It turned out that the gold standard didn't offer the U.S. monetary system much stability. There were repeated money supply difficulties, including the Panic of 1907. During the panic, people streamed to the banks and demanded their deposits. The banks could not meet the demand. They simply did not have enough gold and silver coin available. Many banks went under. People lost millions of dollars. Businesses suffered. Unemployment rose. And the stability of our economic system was again threatened. To prevent financial panics like the one in 1907, President Woodrow Wilson signed the Federal Reserve Act into law in 1913. The act created the nation's first central bank with a board of governors to oversee the Federal Reserve and its 12 district banks, each with its own reserve bank and its own president. Policy decisions about money growth are made by these key officials.
The Federal Reserve has political independence. It does not depend on Congress for funding, and its governors are appointed for 14-year terms. The Federal Reserve is independent within government, but not of it. It is required by law to report to Congress regularly.
When the Federal Reserve creates reserves, it enables the banking system to make loans to businesses, consumers, and governments. This, in turn, affects interest rates.
The Federal Reserve creates the reserves, the raw material which enables the banking system to lend and invest. If the supply of money grows too fast and causes spending to grow faster than the economy can produce goods and services, then prices will tend to rise and the value of money falls. This is called inflation. However, if money doesn't grow fast enough, spending will slow, and so will the economy's growth. Worse yet, the economy could actually decline, causing unemployment to rise. This condition is called recession. With the right amount of money, spending will grow. Full employment and reasonably stable prices will be easier to achieve. The number one job of the Federal Reserve is to try to achieve a balance between money growing too fast and too slow.
But the Federal Reserve isn't the only factor influencing the economy. The taxing and the spending of the federal government have a great impact on prices, production, and employment. Even events outside the economy, such as weather, and actions taken by foreign governments, often make the job of maintaining economic and financial stability more complicated.
Reduction of 1% in the unemployment rate is a reasonable rule of thumb that assumes